Well, good morning, everybody. Welcome to the BDO Insurance Sector webinar. Thank you for joining us today. My name is Graham Handy. I'm Head of Insurance Advisory and Actuarial and partner at BDO. Firstly, just want to touch on the usual housekeeping points. So today's webinar is going to be recorded. We will circulate the slides and we'll circulate the recording in a few days' time. Your lines are automatically muted throughout the webinar. So please submit your questions through the question panel. Some of you have asked questions in advance, and thank you for that. If we don't get to those questions or any other questions that are asked during the session, then we will come back to you offline. So let's go to the first slide, I think. We're going to sweep through in our usual pacey way a wide range of key themes, the challenges that we're seeing across the general insurance markets at the moment. I'm joined today by Sandi Restrepo from Actuarial. We've got Nicola from Regulatory, Michael and Isaiah from Tax. We've got Sandi, Dosanjh, Steve Dello from Digital. And as usual, I want to say a massive thanks to Rima Stevenson, who always works so hard to make these events come off cleanly. Fingers crossed. Perhaps before we hand over to those folks for a deeper dive, it might set the scene if I share a few thoughts on what I'm seeing at the highest level in the market at the moment. So I guess first of all, it strikes me it's been a very fluid market for a while now. 2023 stands out for me as a dramatic year for claims, but alongside that, an unusually profitable year for the industry. And that's against that claims backdrop. There are nuances, of course. I would note there's been a high level of natural disasters globally, a large proportion of which have been in insurable markets. And closer to home, we've seen a 16% uplift in storm damage here in the UK year on year. The retail general insurance market has come under a lot of pressure from high supply side inflation. And that's come at the same time as quite a lot of transitions still from the pricing reform, the consumer duty focus on value for customers. It hasn't let up so far in 2024 either. We've had severe weather events across the US. We've had 3 major storms here already this year in the UK. And yet the profitability has generally held up. There are, of course, some exceptions, but it'll be interesting to see a bit more detail around that, and we'll get that from Sandi shortly. And secondly, the other thing that strikes me is the regulatory agenda. The priorities around governance, they continue to sharpen. We've got to focus on effective challenge from boards, the control environment for our companies. There are themes of regulatory focus emerging with the PRA inquiring around clean, i.e. solvent exit strategies. The FCA seems to be turning more attention now to the wholesale markets. So I would expect dialogue from your supervisor in those areas. We'll have to see, but I'm seeing emerging appetite for large-scale product remediation again. And 2 examples would be the multi-occupancy buildings insurance market and the intense scrutiny on the motor dealer financing. Nicola's going to give us a more detailed run through the regulatory landscape, and I expect we'll hear from Sandi and from Steve on the corporate governance code too. And then the third thing that I see at a high level would be IFRS 17. The results settling down somewhat after what was a rocky mid-year, the first time IFRS had been sort of put out to the markets. Analysts and insurance entities seem to be getting more familiar with the disclosures. Expectations are still aligning though, and the financial close process, that's more rehearsed, but still plenty of room for improvement. And I think the next steps we're going to see from CFOs, from finance functions, are going to be around that sort of focus on the financial close process, investing to automate what has been some quite tactical solutions to getting across the reporting line in the near term. That's not going to be a trivial exercise, and realistically clients are expecting a multi-year journey of improvements to the production process. Also around IFRS, I think there's a shift towards KPI measures, and Now we've got IFRS as a disclosed item. What kind of KPIs should management teams hold themselves to? There's tax, of course, and we'll hear from Michael and Isaiah on the most pertinent changes affecting the coming from the spring budget. There's the evolution still in the R&D tax credit and opportunities there for people. And more generally around tax, it feels to me like the global minimum tax rate is gathering steam. It'd be interesting to see what Michael has to say on that. And finally, I mean, there's a long other long list. So, you know, we've got talent wars, we've got operational resilience, the sustainability of our businesses. That's sustainability for corporate long term, but also sustainability of the environment we're operating within. Effective relationship management with professional services firms like BDO, part of the ecosystem, and so on. So all of that is kind of on board's minds, and we can't cover all of that, of course, but they do all resonate. What we will dive deeper into is the operational digital challenge and how we're seeing clients sort the wheat from the chaff in terms of their plans around that. So with that, let's go to our panelists. And whilst we'll aim to have some time for questions at the end, as I said at the start, we will make sure we deal with any questions offline if necessary. Keep them flowing. With that, let's turn to Santi.
All right. Thank you, Graham, for that intro. So it has been another interesting year in insurance, and I will be covering a brief overview of the 2023 financial results and some major developments, trends, challenges, and risks for 2024. Next slide, please. So reinsurance, specialty, and commercial lines have had a stellar year, while personal lines have remained stable without noteworthy trends in profitability. So we've got graphs here comparing the combined ratios for 2022 and 2023. These graphs will show us which companies improved their combined ratio, those below the red line, and which saw a decline, those above the red line. So the data tell us that 2023 was particularly good for commercial, specialty, and reinsurance lines, with a few exceptions. Personal lines, however, didn't follow a clear trend, with results scattered on both sides of the red line and close to the line itself. The success in commercial, specialty, and reinsurance lines is attributed to better rates as we approach the peak of the hard market, and strong performance in managing natural catastrophes and large losses. And this despite the slight increase in natural catastrophe insured losses over the year. Some outliers did experience increased loss ratios due to ongoing deterioration of their casualty lines and one-off peak large claims. Even with these outliers still remained profitable. On the personal lines side, there's no strong positive or negative trend. And this is despite them experiencing strong claims inflation and increased storm claim payments in the UK, as Graham mentioned. And there's been noteworthy premium increases, which I know we have all felt. And with these companies have just kept with similar results to last year. Now, personal lines insurers also face regulatory pressures to ensure customer outcomes, which we'll discuss further in the presentation. And overall, as an added bonus this year, the high interest rate environment has led to favorable investment returns, boosting overall results. Next slide, please, Rima. So moving on into natural catastrophes and the effect of climate change. So I'd like to emphasize the urgency of adapting to the changing climate, as 2023 was the hottest year on record. There are some interesting shifts in the profile of natural catastrophes, and these are possibly due to climate change. So in 2023, the world faced economic losses of about $280 billion due to natural catastrophes, with insurance covering only 108 billion of this amount, so a bit less than half, clearly. Severe convective storms, particularly in the US and Europe, have become the second largest loss-making peril after tropical cyclones. In 2023, severe convective storm insured losses hit a new high of 64 billion. So while growth in general growth of insured values and construction costs are significant factors in these losses. Climate change also plays a role, and the exact impact varies. So Swiss Re reports that the year saw a record number of 142 insured loss-inducing catastrophes, with medium severity events being the fastest growing category here. Insured losses also now regularly exceed 100 billion annually, even without a major peak loss event. And this is an interesting insight with ramifications for internal models and the way in which we may wish to structure reinsurance programs going forward. Now, switching now onto the regulatory side, the prudential regulatory side, the PRA has just rolled out their business plan for the year 24-25. And it's full with ambitious goals that promise to revitalize the UK's financial sector, including the insurance industry. At the heart of this plan is a support for new regulatory objective under the Financial Services and Markets Act, which is to support the competitiveness and growth of the UK. And in line with that, the PRA is introducing measures to simplify the solvency regulations in the UK, which will not only reduce the reporting burden, but also make it easier for new startups to enter the market. Other noteworthy items in the PRA agenda include putting strong emphasis on operational and cyber resilience. So they're rolling out a series of initiatives throughout the year to ensure our financial institutions are robust and secure. For the first time, non-life firms will undergo a dynamic stress testing exercise in 2025, and this is a significant step forward in assessing and enhancing the industry's stability. The PRA is also turning its attention to cyber underwriting risk, particularly for firms with significant exposure. And they're also determined to keep a close eye on internal model drift within non-life firms, aiming to boost the effectiveness of the internal model validation performed by firms themselves. And on the non-life side, last but not least, the PRA is also bracing for a lag on the emergence of claims inflation in commercial and specialty lines, which means they will continue to be vigilant and proactive in monitoring reserve loadings for inflation. On the life insurance realm, there's going to be a thorough examination of funded reinsurance arrangements, and the focus here is on the risk associated with collateral standards and credit risk concentrations. At the same time, Europe has also been pressing ahead with amendments of their own to their Solvency II regime. So changes being discussed in Europe cover proportionality, quality of supervision, reporting, long-term guarantee measures, macroprudential tools, sustainability risk, and cross-border supervision of groups. And in particular, they are looking at also reducing the cost of capital used for the risk margin in line with what the UK has done already. They're looking to reduce the cost of capital from 6% to 4.75%, with potential for further reductions in 5 years. They also introduce a tapering effect on the risk margin, as the UK has also done. And this is to reduce the sensitivity of interest rates on the risk margin. They're also adding powers to the supervisor. The supervisor will have the ability to require insurers to put into motion predefined recovery plans or to suspend bonuses or distributions. And if the entities are faced with liquidity issues, the supervisors will be able to temporarily suspend dividends, bonuses, and in extreme cases, redemption rights for life policies. So all these amendments have been provisionally agreed already, and they will be discussed in the European Parliament next week. So plenty to be watching out for in terms of the prudential regulatory agenda. Moving on to digitization of insurance and its impact. So in the digitization of insurance, there are various risks and opportunities emerging. The majority of digital tech applications arising are for making it easier for more people to get their hands on insurance. And this means changes in methods for distribution of insurance products. Embedded insurance, I'm sure we've all heard of it, is an example of this. And with embedded insurance come questions around how to price and manage the risks from coverages that have been perhaps oversimplified to facilitate quick sales. There is a double risk here in that loss ratios could be higher than expected as coverage is greater than intended. Or alternatively, if coverage is tightened to a great degree to facilitate distribution at scale, then the value for money to insureds could be lower than what the FCA would expect. For more traditional risk carriers, however, the digital tech is about getting sharper at underwriting, cutting down risk and measuring it better, which means better underwriting decisions and lower expense ratios. Over 2023, we have seen an increase in companies engaging in pricing transformation, especially in the commercial and specialty sides, and this is set to continue during 2024. There are new technologies facilitating data ingestion and streamlining of underwriting processes, including technical pricing, and insurers are eyeing between 3 to 8% cut in their loss ratio thanks to digital underwriting and better pricing. All these could be a differentiator in the medium term as the underwriting cycle begins to soften. However, in our experience working with companies going through these changes, the success of these digital transformation projects depends to a large degree on how well the ultimate target operating models have been thought through and how these new modeling and data capabilities are effectively covered by the company's governance structure. Now, last but not least, the underwriting cycle. There is a sound reason for expecting a softening market as those great profits from 2023 get reinvested in increased capacity. There are already signs that reinsurance market is plateauing as rate increases have been lower in March renewals than they were at 1/1. However, there are factors that could support the current rate levels, like, for instance, inflation in casualty lines, where even though casualty reserve deteriorations were the focus a couple of years ago, inflation does not appear to have made its way fully into claims. Inflation could still catch up with commercial insurers, prompting some deterioration if allowances have not been sufficient, and the PRA has signaled that they're alert to this. Also, current rates could be supported as 2024 could be beset by large claims. So the Baltimore Bridge collapse being a first man-made catastrophe early in the year, the effect of this loss will undoubtedly be felt by those participating in the marine liability and marine reinsurance markets. Also, the 2024 hurricane season is being predicted to be very active and well above the 10-year average due to the combination of a high likelihood La Niña phenomenon towards the second half of the year and record warm water temperatures. Now, in closing, I hope this has been an informative, quick overview of 2023 and a preview of what's to come in 2024. The journey through 2024 promises to be both challenging and exciting, and when we're committed to providing the exceptional service you've come to expect from us. I'll now hand over to Nicola. Thank you.
Brill, thank you, Santi. Good morning. My update is focused on FCA priorities and conduct matters. So maybe just moving on to the next slide. So in terms of headlines, so based on what we've seen in the market, the FCA's Dear CEO letter from September last year, the Regulatory Initiatives Grid from November last year, and the FCA's more recent business plan, it's certainly a story of some new areas of focus, but broadly a continuation of some ongoing themes, with conduct particularly improving outcomes and value for customers and consumers remaining a prominent feature on the reg agenda, with the backdrop of cost of living crisis and with consumer duty coming into force. Governance, culture and non-financial misconduct also remain high on the agenda, with the FCA encouraging action to drive a more diverse workforce and carrying out work themselves to review and carry out more activity to inform their judgments on impacts and progress made in this area. Operational resilience is also a priority for the FCA and the PRA, with requirements coming into force next year, but particularly with regards to aspects such as how third parties are managed, for example, in terms of that resilience question. And a few other final points I just wanted to pick up from this slide. So AI remains a hot topic for the industry, and I just wanted to highlight we've sort of seen recent practical ABI guidance published recently with a focus on the best interests of consumers, and that's been centered around 5 principles. So very much focused on an aim at maximizing opportunity to improve affordability, accessibility and availability. The FCA have also been clear that they're focused on competitiveness in the sector. So, for example, ensuring their rules to protect consumers don't impact wholesale customers negatively. And I think also worthy to note that with a general election likely before the end of the year, there may well be changes to the regulatory strategy ahead. Moving on to the next slide. So here I wanted to spend a few minutes just talking about some of the themes that we're seeing in the FCA supervisory space. For example, in terms of Section 166 activity, it was very interesting to see that just taking the quarter after Consumer Duty landed, so that was between July and September last year, so that being the first since Consumer Duty came into force, we saw 18 Section 166 reviews commissioned. So that's in terms of the FCA's stats that they publish. And in terms of some of the themes, so 7 of those were in the insurance and protection space, primarily in the GI space. And that is sort of more than we saw commissioned in that sector for the prior 3 years. So certainly sort of an uptick in the focus in that space. We also saw an increase in those commissioned in Lot C, which is the conduct of business lot, and also with a slight increase in those where the FCA appoints the firm rather than the firm appointing the individual to do the review. And topics in the spotlight. So consumer duty is becoming a common thread with topics such as fair pricing and value, customer outcomes and conduct risk frameworks, and governance being covered in the scope of the requirement notices coming out. Now, just focusing on sort of some of the products in focus at the moment. So we set out some here, but so multi-occupancy insurance and gap insurance are both areas where action has been taken to improve fair value to retail customers. Both products have the potential to involve quite high commissions, and the FCA has considered that not enough have been done by some firms to date, and particularly demonstrating that relationship between commissions paid, work done, and value to consumers. For GAP, the FCA quoted examples of 70% of value of the premiums paid out in commissions, and they also communicated a few months ago that 80% of the market has now paused the sale of GAP while changes are made to the product. The FCA has also made sounds around looking at premium finance, so where customers generally pay more for monthly instalments than a single premium for an insurance product. The regulatory requirements and PROD specify how to assess price and value, but firms relying on benefits that those instalment payments can provide. However, it's sort of clear that firms should be taking a sort of closer look at the pricing of premium finance and making sure that it does offer fair value and can be justified. And then finally, just motor insurance, I think is also worth to note, has been in the spotlight, and noting the FCA's recent publication on valuation practices. So where a customer makes an insurance claim with a focus on written off or stolen vehicles, I think another good example of how the FCA are using consumer duty outcomes-based approach alongside the rules in ICOBs in terms of some of their comms and their areas of focus. Now, just moving on to the next slide. So I don't want to spend too long on consumer duty because I know that it has been well discussed, but I just want to spend a little bit of time on board reporting and close book with the upcoming July deadline of this year. So we've worked with a number of firms to develop their consumer duty MI and reporting with, as I mentioned, the first board report being due by the end of July this year. And some of the sort of key thoughts in terms of what's quite useful and practical in this area. So I think firstly, ensuring that you've identified desired customer outcomes, and this should consider relevant inputs such as customer journey mapping, product life cycle, also considering whether the existing conduct data sources monitoring MI are appropriate for evidencing delivering of those desired customer outcomes, making sure that you've assessed what MI you still need to source in order to better evidence that you're delivering those outcomes, and that should include some of the examples and consideration of the examples that the FCA have set out in their guidance paper, and also ensuring that you've considered the Consumer Duty reporting governance framework and how information does flow up, is escalated, and reaches the board and allows an understanding of root cause analysis as well as actions being driven from that reporting. So I think taking that sort of methodical approach allows you to make sure it's evidence-based, gives you a clear rationale, but also is easy to build on in the future and kind of continue to evolve. And then finally on the next slide, so just touching on closed book, with again the implementation for closed book requirements from Consumer Duty perspective by the end of July this year. Firms are progressing well in this space with their projects. Some firms with few closed books implemented changes last year, but those with more extensive portfolios are working through that this year. And I think in terms of Sheldon Mills gave a speech a couple of months ago, which highlighted that the FCA has certainly not forgotten about this deadline and identified some sort of topical issues in this space. So it's fair to say that the FCA is certainly looking for change in action, with a focus on areas such as missing information, so where legacy products, particularly very old ones, may be missing T's and C's or customer information. And where that is the case, the FCA is expecting a higher degree of testing to check against the outcomes for those customers, for example. Lack of contact with consumers. So the FCA highlighted this, and they're expecting efforts to engage more with customers, for example, particularly where customers have rights attached to products. So taking additional steps to help customers understand those rights. And also sort of touching on the sort of thornier issues of vested rights. So here the FCA set out their expectation around, taking appropriate action in this space. For example, those products with barriers to exit, should be looking at and reconsidering those exit charges and potentially removing those. So certainly a call to action in that space too. So I think that was a little bit of a whistle-stop tour in terms of some of the FCA reg priorities and agenda. But I was now going to hand over to Michael to kick us off on the tax update part of the session.
That's great. Thanks, Nicola. So I'm Mike Whiteside. I'm a director in the insurance tax team here at BDO. I'm going to talk a bit about updates in the tax area for corporation tax and for other taxes and other announcements that were at the spring budget. I'll spend a bit of time going through CT updates and then a bit more time on some of the other things that have come up in the tax arena and from the spring budget before I hand over to Isaiah, who's going to talk about R&D tax credits, which is an area that's changed quite a lot over the last year or so. So next slide, please. So just touching on recent corporation tax updates, including spring budget. Actually, from a corporation tax perspective, the spring budget didn't hold very much at all. You will see the main announcements were in other areas of tax, which I'll come on to in the next slide. But I've also thought it'd be worth covering some of the recent areas of interest from corporation tax perspective and recent updates outside of the spring budget. I'm sure you'll all be familiar with the fact the corporation tax rate went up to 25% from April 2023. So that's the mainstream tax rate. There is still a smaller companies tax rate of 19% with tapering between thresholds. Those thresholds are reduced by the number of associated companies in the group. So to the extent that you are a larger group, you're generally likely to be at the mainstream rate of 25% now. Probably, and Graham alluded to this in his introduction, the biggest area of interest in the corporation tax arena for the largest multinationals, those with revenues of over 750 million euros, is the global minimum tax rate of 15%, which continues apace. UK legislation was enacted in 23. There are various other jurisdictions, lots of other jurisdictions enacting legislation as we go. There are certain safe harbors available, for example, applying effective tax rates based on country-by-country reporting, as sort of the regime comes in, and reducing potentially the level of administration required to ensure compliance. In the last few months, that's been a large focus of our work as auditors, also in advising companies on on the implications has been around disclosure in their accounts. So FRS 102 and IAS 12 both had amendments made to say that the implications of Pillar 2 did not have to be reflected on the deferred tax balances at the balance sheet date. So, for example, for December 23 year end, but a disclosure was required to say that the exemption had been made, and note any quantitative or qualitative information that needs to be added on the implications of Pillar 2 arising. Just quickly, I mean, FRS 102 and FRS 101 allowed a exemption for subsidiary accounts where a appropriate disclosure is made at the consolidated group level, whereas IAS 12 didn't. But just generally, watch the space Pillar 2. It's going to keep traveling, moving very quickly around the world. So, you know, for those largest businesses, obviously, it's probably the main priority for tax teams at the moment. Just a couple of other things I'm going to touch on. Capital allowances. Capital allowances have changed a lot over the last few years in terms of the percentage of deductions you can get up front. The super deduction, the 130% ended as planned. The 100% upfront deduction is now in place. There are sort of two 100% upfront deductions. One is full expensing, which has no limit, and that's been made permanent. And the annual exemption, annual investment allowance of 1 million has been extended. That's also 100% upfront deduction on qualifying spend. There are slightly different assets that the AIA can allow the upfront deduction for, which is why both of those are still in place. Long-term business fixed capital. So during 23, new regulations were laid. This affects life assurance groups specifically, and the regulations were enacted to kind of clarify what would be a structural asset. So assets that sit outside of the life assurance trade, because those are taxed in a different way, for example, assets that are held to back the long-term business. So the structural assets are things like holdings and subsidiaries, owned or occupied building, etc. Largely a clarification, but the regulations were enacted towards the end of last year to make that clearer. IFRS 17 adoption. The commencement date was 1 January 23, so we have seen a number of accounts under IFRS that have obviously applied the IFRS 17 rules. From a tax perspective, the main thing of interest is the transitional adjustment, so the restatement of the opening balance sheet, and bringing that into tax to prevent things from being double taxed or falling out of tax entirely. And for life insurers, that transitional adjustment is spread over 10 years on a straight line, and for general insurers, it comes in all in one go. Partly mention it because we have been looking obviously at accounts for December 23 year ends where the accounts have been restated to apply IFRS 17. There are obviously deferred tax implications of that, and deferred tax needs to be applied to any changes arising from IFRS 17. And also when the 23 year ends, assuming December year ends, for example, need to be filed, the transitional adjustment needs to be included to the extent relevant for example, 1/10 for life insurers and for all of it for general insurers. That's my main updates on corporation tax. If I just go to the next slide, please, Rima. I'm not going to go into a lot of detail about a lot of these things. There's a few things on the slide. I know the slides have been circulated afterwards, so feel free to look at your leisure. Just the three things on the left, the thing that connects those three things is they are all subject to some level of consultation. There's been a lot of pension changes announced over the last year or so. I think from a tax perspective, one of the main interesting things is the authorised pension surplus tax rate has gone to 25% from 35%, and that effectively applies when surplus is extracted from in the employer pension scheme. So it's gone down to in line with the mainstream corporation tax rate, whereas previously it was obviously significantly higher. There are quite a lot of other changes on pensions and also consultation about some of the potential changes to the rules. ICE again, the introduction of UK ICE as a consultation running on that. UK captive insurers, we haven't seen a consultation yet, but that will be something of interest when it comes in. The only other consultation I was going to mention is the Common Reporting Standard. So this is where certain financial institutions have to report certain products, details of certain products held by individuals in various jurisdictions. There is a consultation that's going to propose to expand that so that UK financial institutions have to report UK resident policyholders, if you like, or account holders. Now, generally, those rules don't apply to a lot of insurance products. They don't apply to general insurance products generally, or protection, etc. But there are some cash value products which are required to be reported. So those are of interest. Those are things like investment bonds, life investment bonds that life insurers write. Just rattling through the ones in the middle. So actually probably the biggest changes in the spring budget that were announced were quite heavily trailed, and those are the things I've got in the middle of this slide. I'm not going to dwell on them a lot, but the reduction in the NIC rate for employers and the abolition of the non-dom tax regime, particularly on the non-dom tax regime. If that's something of interest to you, do feel free to reach out to us and our experts, because it'll be interesting to see how that changes over the next year or so. Change to benefit reporting. So just very quickly, HMRC just announced that from April 23, payroll and benefits become mandatory, abolishing paper P11Ds. This is sort of in line with how HMRC would like to see things going in terms of it just sort of making things making tax digital, and sort of effectively attempting to simplify the tax administration regime. And finally, on the right hand side, I just wanted to mention a couple of things on sort of tax risk governance. We spend a lot of time supporting businesses on business risk reviews. This is a review that's carried out by HMRC to assess the level of risk that they consider their clients, being you guys, to be, or customers. And we've seen quite a lot of activity in this area, and we've been supporting businesses on it. Also, for those of you that aren't large enough to automatically have a customer compliance manager, there is the recently announced temporary customer compliance manager initiative, which may allow those mid-sized businesses to ask for a contact at HMRC to effectively be their CCM, to improve sort of engagement and interaction between HMRC and their customers. And that was my update, and I'm going to hand over to Isaiah now, who's going to talk a bit about R&D. Thank you.
My name is Isaiah, the manager within the R&D Tax and Innovation Incentive team. Very quickly, for those that haven't made any R&D tax claims previously or not fully aware of the scheme, this is looking at identifying qualifying expenditure relating to R&D activities. And these expenditures can be used to offset the tax liability for profit-making companies, or it can be in the form of tax credits. And you can go back 2 years after the end of an accounting period to make an R&D tax claim. When we talk about R&D, what they're really looking at is projects within the company. So any new system implementations, enhancements of existing systems, where there's technological challenges in the implementation of the enhancements, where the knowledge of how to solve these challenges is not readily available in public domain. With that in mind, there have been a lot of changes within the R&D tax regime. So HMRC have increased scrutiny in recent years due to various irregularities with claims they've been seeing. So they have introduced quite a few changes. And in terms of the main changes, these have been introduced over the last year or so. Going back, the main ones from the 1st of April 2023, they have introduced relief rate changes. So previously, where you could claim up to 15% for large companies and up to 25% of your expenditure for SMEs, Now these are being reduced, where you are now looking at claiming about 18% for small companies, and large companies are still at 15%. The main changes that I would say that's relevant to your sector, which is actually a positive change, is the inclusion of pure maths and modeling as part of the R&D claim. So previously, there weren't any allowances for projects that are focused on pure modeling. These were all focused on the implementation of new systems, so anything that was more technological in nature. But from the 1st of April 2023, my account period started on the 1st of April 2023, we are now allowed to claim for projects purely looking at actuarial sciences, complex risk management, risk modeling exercises, regulatory modeling, any areas related to leveraging complex data models and statistical inferences techniques, complex pricing models. These are all going to be allowable now with claims starting account periods from the 1st of April 2023. Other changes that we introduced is the way that the claims have been submitted. Previously, you were allowed to submit with a report in any format that was suitable for the company, and that was just included within your tax computation. Now, there has to be a additional information form that has to be submitted beforehand, before the numbers are included in the tax computation and submitted to HMRC. Other changes to highlight from 1st of April 2023, SMEs are allowed to can still claim at a higher rate where they are seen as R&D intensive, and this is based on their R&D expenditure being about 40% of their total company expenditure for that particular year. For more recent changes that have been introduced, these are looking at from accounting period starting 1st of April 2024, so very recent. These are merging the small company scheme and the large company schemes. So from going forward from the 1st of April 2023, you're going to be looking at one R&D scheme. There are other changes that have been introduced as part of that going forward. So anything related to overseas costs, those would cease to qualify. But you can also look at subsidized R&D costs can now qualify where they didn't qualify previously. There's certain rules with regards to contracted R&D, and these can go into get a bit more complicated. But the main message is there are lots of changes happening. HMRC, there's quite a lot of scrutiny from HMRC. In any situation, in any doubt, feel free to contact us to go through any of these changes. Thank you, and I'm handing over to Sandi.
Hi everyone, I'm Sandi Dosanjh. I'm a partner in our digital risk business. For digital and technology, we're going to be focusing on regulatory compliance today, specifically the UK Corporate Code and the EU Digital Operational Resiliency Act. Now, let's start with the UK Corporate Code and level set for everyone who's on the call. The UK Corporate Governance Code is a set of guidelines and recommendations for the boards of listed companies in the UK. Now, the objective is to promote high standards of corporate governance and accountability, and to foster trust and confidence among investors, stakeholders, and the public. Now, the code does not have legal force, but it's actually enforced by the FCA through its listing rules, which requires companies to disclose how they have complied with the code or explain why they have not. The code applies to all companies with a premium listing of equity shares and therefore applies to the FTSE 350 as they are included within this category. The FCA actually monitors the compliance of the FTSE 350 companies with the code and publishes periodic reports on the quality and trends of their corporate governance practices. So what are the new updates to the code? The updates that have been communicated publicly early in January this year by the Financial Reporting Council, or FRC, are as follows. Firstly, the board has the responsibility for establishing an effective risk management and internal controls framework, and also has the responsibility for maintaining its effectiveness. The code update actually includes operational, reporting, and compliance controls. So most FTSE listed organizations have historically focused on financial reporting controls only. So this represents new scope. Organizations are expected to have controls in place to manage the material risks linked to company strategy and principal risks as per the annual statements. Other elements included are risk management and reporting, but I would say that the internal controls point is the most notable and material change in the revised updates. Now, the updates do set out an expectation that directors will have to take increased responsibility for stronger internal controls, including an annual review. So when? Those who are FTSE 350 listed and governed by the FCA will need to have an effective internal control framework in place by the 1st of January 2026. So what are we seeing in the insurance sector at the moment with regards to this? We're seeing boards in particular, audit committees, becoming increasingly interested in this. And what we're seeing is our FTSE 350 clients are asking us to assess and compare how their current control environment and processes, which have been centered around the FCA, external audit, and PRA compliance, compare to the likely requirements of the updated code. We're also seeing second line risk functions, creating in-house roles and recruiting specific team members that will be responsible for taking the lead on delivering this compliance ready for 2026. And finally, we're seeing our clients that are currently going through technology-based change, which could be implementing a new front-end system, a finance system, or moving to the cloud, asking us to perform a quick review to ensure that the process and controls that are being considered throughout this transformation, so it doesn't leave them exposed to the code updates at the point of go live. So what else are we doing and what makes us different? I think what makes us unique is that whilst we have a significant amount of collateral in terms of insurance sector process maps, controls libraries, and a really strong IT controls function, what we're not doing is enforcing boilerplate solutions to our clients. Complying with the revisions to the code, and specifically internal controls, that shouldn't be seen as a new project or wholesale change to how you manage risk. It should be centered on understanding how and leveraging the risk management procedures that you already have in place to meet your existing obligations to your external auditors and regulators. Now, our job is to use our skilled SMEs to help you identify gaps in your IT and financial process control environment and help upskill and supplement our client teams to plug those gaps and consolidate the control environment. Now, a number of our clients have reached out to us to discuss embarking on a 6 or 7 figure control design project. And our advice is always start small. Perform a gap assessment, really take stock of your own control environment, where you are strong and where you think that you're weak, so you can develop a pragmatic roadmap to help you achieve compliance by 2026. So feel free to get in touch if you'd like to discuss your control obligations under the code. Steve, over to you for DORA.
Thank you, Sandy. Good morning, everybody. My name is Steve Dell. I'm a director in our digital team, and I'm just going to give you a quick overview of the Digital Operational Resilience Act, known as DORA. This is an act that's applicable to EU members, but it does have a footprint in the UK for organisations that may have overseas operations. What is it exactly? As I said, it's an EU regulation. It's aimed at strengthening the IT security of financial entities. You've heard already from some of the prior presentations the phrase digitalization. I think we all recognize the huge extent to which technology plays a part in delivering internal operations, solutions to customers, and the regulators have recognized this presents a huge amount of risk to organizations and customers alike. For UK organisations, there will be some crossover with areas such as the Operational Resilience Act. Same wording to a certain degree, but the DORA has a much wider catchment than Operational Resilience in the UK. Also, the PRA requirements around outsourcing in the UK has an element of this as well. But I would say that this is much more prescriptive and covers a wider range of areas. And I think the regulator's intention is to try and bring together a number of areas of IT risk management that have operated in silos, and to try and bring them into a more holistic approach to managing technology risk. Who's it applicable to? There's a list of over 20 different types of financial institutions, but the ones that are applicable in this audience will be insurance and reinsurance undertakings, intermediaries and reinsurance intermediaries. There are some exclusions for smaller organisations, for example, those that have gross written premium of less than 5 million euro. And as you would hope with regulation, the word proportionality comes into the regulator's wording. Quite what that means is often hard to determine, but it means that there is a way of rolling this out in a way that's relevant to risk profile, size and complexity. So the timeline is the initial Act details were released in January 2023. The actual go live date is January 2025, and that's obviously not very far away, especially since the accompanying regulatory technical standards only came out in January of this year. Those documents are very helpful because they have a lot of detail in it. Probably, actually, if I think about it, more detail than things like even GDPR, operational resilience have had. So they are useful, but only having them available for 12 months is proving to be quite challenging. So what does the actual Act cover? So in the circles there, you can see the 5 main areas. So the first one, ICT risk management. There's a clue there in the title in the sense of it's about identifying, monitoring, evaluating risk. But actually also that one contains a huge amount of work because it's around the establishment of protective and preventative measures around technology risks. So that's controls. So if you think about technology controls as a whole, that's huge. Having to put all those controls in place and validate that they're operating is a big piece of work. Second, ICT related incident management. So this is not only about having incident management procedures in place to prevent and respond to incidents, but also to actually be able to evaluate, classify and report on incidents. So I think especially that reporting piece is new. Thirdly, testing. So operational resilience, as we understand it in the UK, requires testing around important business services. This is much broader. It's about all your technology platforms being tested, and it's quite prescriptive in terms of annual testing, but then every third year independent testing, so not within your own organisation, which needs to be reported to the regulator. So again, something that's typically not in place. The middle one at the bottom there, managing of ICT third-party risk. So I mentioned earlier that the PRA regulation around outsourcing of third parties will touch on this. I think we all understand the level of outsourcing is huge. So that's about inventories, risk evaluation of third parties, due diligence. And then the final one is around information sharing. So the regulator is keen for everybody to be able to understand the threats and vulnerabilities they're experiencing, what incidents they've had, and then creating an information database that can be shared with everybody so everyone understands what challenges other people have faced and how they've been dealt with. Next slide, please. So where are organizations in this? I would say the evolution of responses has gone through 4 stages. The first one is, to what extent does it apply to an organization? Once you've kind of worked that out, where are you in terms of your current control environment versus where you need to be? Then that leads into roadmaps and development of various security architectures, target operating models to kind of close that gap. And then finally, there's an element of project management. I would say that the majority of clients we see are still in those 2 middle areas. I think regulation is something that people respectfully observe, obviously, and align their budgets to, but it's not always priority for some organisations, and getting over the line can be quite a challenge. I think one thing I'd like to say about this is, whilst it's not directly applicable to UK-based organisations, what it actually contains represents good practice technology risk management. Now, I do a lot of IT internal audit work around a huge number of areas that within DORA, and we continually find large gaps in those control environments. So you might want to consider DORA as a good benchmark for assessing your own technology controlled environment. You know, what DORA is saying is probably where our own regulators will probably want to take this, I think, because it's not, I don't think, overly onerous, given the huge amount of technology that we will probably see pouring into organisations over the next few years. I think this is something that everyone will need to focus on to manage their.
I think that's a really good point, Steve. And you know, I think that's the benefit of, you know, sort of looking outside our borders and learning from other parts of the world as well. So look, I mean, that's been fascinating, and you know, I just want to sort of first of all thank every one of our panelists for their insight and time. There are a few questions coming through. I just want to use a couple of minutes to sort of cover off a few of those. So first of all, there was a quite an interesting question on tax, actually, Michael. Practically, you know, so practically, how are things at the HMRC, and BDO finding ways through the resource constraints that we've been hearing about in the press?
Yeah, I mean, it's a really interesting point. I mean, in some instances, HMRC very well resourced, and we've seen that for sort of some ongoing inquiries and stuff, and sometimes where they're not. It can sometimes be hard to kind of get certain administrative things like allocating payments, and the lack of resource at HMRC makes that kind of difficult. I think I'd say there are things like R&D, which is where they're focused on at the moment. And obviously, I spoke about that, and that's been heavily trailed in the press around, you know, the issues they've got with R&D and how they're challenging. That's where their investment has gone in terms of resources. But that obviously means potentially resources are not focused in other areas. Just actually on a related point, there is actually tomorrow is the Tax Administration and Maintenance Day, which kind of ties into your question, because tomorrow is the day when they're going to release potentially other information on sort of, like I say, administration and other consultations, that stuff as well. So kind of interesting timing, Graham. Okay,
so they are squeezed, basically. They are squeezed.
Yeah, certainly in some areas, maybe less in others, but yes, they could always do more resources, I think, is certainly what I'd say.
Okay, lovely. There's a question here for Nicola. So you mentioned 80% of the gap market has been withdrawn. Really? You know, isn't it basically a dead product now?
No, it's a good question. So yeah, I guess that 80% was a quote from an announcement in February. Since then, the FCA's asked for the rest of the market to withdraw. They were given until the end of March. I understand that actually for some online providers that there's been an extension until the end of this month. So you are right, the rest of the market is withdrawing whilst changes are made, etc. But I think at the moment, because of that extension, I've probably hedged my bets in terms of sticking to a published quote around percentages. But
so it's basically it's transitioning to effectively a dead product, probably. Yeah.
It will come back, I have no doubt, in terms of it, but just in the right way.
In the right way. Okay, lovely. And then we've got probably time just for one more of the questions that have come through. Santi, going back to your presentation at the start and all the sort of dynamics around claims and prices, is it getting easier or is it getting harder for brokers?
Well, brokers have not had it easy over the past couple of years, where rates have been probably more than a couple of years, maybe 3 years, where rates had been hiking quite strongly. Now, I think brokers will probably start seeing it get easier going forward. I would say it's going to be as easy as in the years of the very soft market back in 2016, 15. On the other hand, rates, the broker remuneration, or brokers are remunerated as a percentage of the premium. So high premiums are actually good for their financial strength, or and they have very fixed cost base as well. So any reduction in premium, they will feel it in profits. So yeah, that's my answer to that question.
So they're having to work quite hard, but at least they're making money when they do get it away, I think is what you're saying.
Yeah.
Okay. Let's not cry too much for them then. for any of the brokers on the call. I'm sure you can fill us in offline. So look, I mean, we are up against time. I want to thank the whole team for their presentations. So I want to thank everyone who's joined us for your attention and your interest. I'm conscious we haven't had a chance to answer everyone's question, and we will come back to people offline with any that are open. You can tell that my colleagues are delighted to hear from you on any of these topics, and I personally, I'm always happy to talk to folks across our industry on anything that's on your mind, your agenda, whether it sort of plays to BDO's ability to help or not. It's an interesting market we all live in. As mentioned earlier, we've recorded this webinar. We'll send you a copy of the recording. We'll send you the slides.